Hi, my name is Ethan Hoover, and today I will be presenting for my business ethics class the ethical dilemma of insider trading in the stock market. The stock market is a series of exchanges where shares and securities of a publicly traded company or many companies can be bought or sold. Despite there being many different exchanges, one rule in particular reinforces the legitimacy of any given exchange: the rule to bar investors from conspiring via insider trading. Insider trading is the practice of purchasing or selling securities by someone who holds information that isn't public knowledge, according to Investopedia.com. Insider trading, it can result in an advantageous position for individuals who possess non-public knowledge, which in turn may make it more difficult for a legitimate trader or small personal investors to turn a profit. The total value of the global equity traded worldwide in the third quarter of 2021, according to Statista.com, was 41.8 trillion US dollars. And though the effect of insider trading may have a minimal impact on the commerce carried out in the stock market, its worst cases may make the business seem a little more crooked than it really is. According to a CNBC article on insider trading throwbacks, Jeffrey Skilling, the CEO at the time of Enron in 2001, in 2006 was convicted of conspiracy, securities fraud, and making false statements to auditors in insider trading after selling $60 million in Enron stock before quitting his position, and that was right before the company was caught in a complicated bankruptcy. One of the earliest insider trading instances in the 20th century, it was in 1929, Wall Street crash, when the head of Chase National Bank began buying short calls, betting against his own company. This gave him a vested interest, quote unquote, in running his own company into the ground, according to the same CNBC article. What may be more disturbing is that Wiggins, the guy who did that, he wasn't found out about it till 1932. And it is well known that other high-level execs were doing the same thing at the time with their own companies during the economic collapse. That means that they were profiting off the loss of their own investors. Nightmare insider trading stories such as these may make even hardcore investors wary of the funny business that might be occurring behind the scenes of every exchange. How can an individual feel comfortable investing their life savings in a company they believe in if that same company isn't transparent about their support for their millions of investors? This is why charges such as wire fraud or insider trading or conspiracy can lead to decades of imprisonment and millions in fines. The charges sometimes being much more serious than the crime, and that's to discourage people from committing white-collar crimes in the first place. Even if we were to look at insider trading as a victimless crime, the practice itself still poses a direct conflict to the ethical theory of Rawls Law, a theory stating that every individual deserves justice and fairness as they hold a basic set of rights and they cooperate within an economic system. That's according to John Rawls' Stanford Encyclopedia of Philosophy article. And at its heart, the stock market truly is an economic system. The problem with insider trading is that there is a major conflict of interest. It's between the companies, it's between the employees, the investors, and the government working in its self-interest. Many companies often offer stock options to their employees to promote employee ownership within that company and to create a vested interest in doing better work. But when an individual employee has access to knowledge before it goes public, the very same employees that may support the company's stock can also make timed and calculated bets for or against that company. The question is it fair for employees to take advantage of the people that support their company? And how much does it really affect them? According to an article on insider trading by 7pillarsinstitute.org, a sample study of 1,000 Wall Street analysts demonstrated the commonality of insider trading, quote unquote, where 2/3 have accepted favors from the companies they followed, they generally deny their integrity has been compromised, and are twice as likely to maintain their rating after an earnings shortfall by a company that provided them favors. Basically meaning that the companies that they got favors from, when the companies did bad, even though they were invested in those companies, they didn't get hurt as bad as someone who didn't get favors. So, how can a market be fair when the extent of insider trading has made its way from the companies themselves to the government to the financial brokerage firms that exchange favors for insider intel? This will result in what might be viewed as a fixed system in favor of the large Wall Street investment firms instead of an equal playing field for investors of all backgrounds alike. Well, though the extent to which the fixing of the market by firms that hold much of the world's invested capital may be vast, it doesn't necessarily limit an investor's opportunities to profit in the stock market. If anything, some pro-insider trading investors may advocate that fixing of the market may make it less volatile and less likely to collapse overnight, as many individuals have already priced in much of the day-to-day moves in any given stock. That could mean less cascading effects as people start to sell out of their positions. Maybe people have already sold out. The stock market still remains the best option for wealth creation in the world. Even though insider trading may present an ethical dilemma, its influences in large part won't affect the 100 million or so Americans that continue to reap the benefits associated with stock investments and the quarterly dividend opportunities offered by companies looking to increase public participation in their company. Thank you for listening.